All right, guys, thanks for joining us on a Friday the 13th. Believe it or not, government just spent millions of dollars to find out that there is no real correlation to bad luck and Friday the 13th, so we have that going for us. Anyway, going forward, this is a strategy that we can use if we have a bearish market assumption, or even an assumption as neutral to bearish in an underlying. It doesn't necessarily connotate the overall market. It could be something like if you were bearish Apple all of a sudden, you could use this strategy using that. One other thing is this is building out upon the put spread webinar that we just did last week. So if you want to go and refresh your memory or see that one, you can go to protraderstrategies.com and sign up for that. This is going to be recorded. One thing I always say at the beginning of these, if you're not very familiar with options or this particular strategy, please go back and rewatch this again as soon as you get this sent to you, because it will allow it to sink into your long-term memory. First time through, some of the nuances of this strategy may go right by you, and you would want to rewatch it again to catch all the nuances of it and to help solidify it into your long-term memory. All right, a couple of things. My name's Eric Wilkinson. Some of you may recognize me from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I've been trading my own money for well over 20 years now, and I'm not here to tell you that I'm going to make you rich or make you a millionaire, but I am here to make you, or help you, take control of your finances, manage your own portfolio, and most importantly, take control of your own risk. You know, if somebody else is managing your own risk, you're paying a lot of money and fees to do that, and by taking control of it yourself, I can assure you, you will probably do just as well, if not better, on your own. My name's are, I've traded everything throughout my career from the Chicago Board of Trade. I've traded everything from stocks, financial futures, commodity futures, currencies, and options, and all of those products in all market conditions, as you can see there. I do have a disclaimer I have to go over real quick. Any opinions, news, research and analysis, or prices or other information contained here, or any other material provided by ProTrader Strategies, associate companies, or employees, is provided as general commentary and should not constitute investment advice or solicitation to buy or sell any of these securities or strategies. Basically what that's saying, you guys, is the reason why I can't just go out and say, hey, you guys should put this strategy on XYZ, is because I don't know your risk parameters and I don't know what's in your portfolio, so it could be counterintuitive to what you're already doing. So you need to take this strategy, look at it, and implement it into your portfolios in your own way. Therefore, it would be more appropriate to you. And bottom line is, do your own homework, and remember that past performance of any trading system or methodology is not necessarily indicative of future results. Couple of questions coming up. This is on ratio put spreads. A couple of ways that it's been known to be said is it's a 2-by-1 put spread or a front ratio put spread. You may have even heard of a back ratio put spread, but that's usually done as a debit, and it's where you're buying to at the money or in the money puts and then selling one out of the money put to help finance a little bit of that, but it's still going to be done as a debit in the other example of a back ratio spread. We're going to be talking about the front ratio spread, which is, or was anyway, and probably still is, one of the favorite trades for professional traders on the floor of the Board of Trade and just about anywhere else. If you've talked to anybody who's done a lot of trading, this is one of their favorites to do. It kind of is like a butterfly, if you will, but it doesn't have the other way out of the money put that you get long. One person is asking, this ratio with low capital, that can't have a naked put. And Byron, yes, it does have a naked put, but I can show you ways to make that work out where you can kind of do it like a broken wing butterfly and buy a really cheap put to take care of that problem. So this is, like I said, going to be needing to have a market assumption or just an assumption in general that's neutral to bearish. But we're going to build this out to where we can still profit if we're wrong and this goes higher. I don't know if many of you guys have watched the daily market commentaries, but I did one with Lululemon, and I'll show you that example also. And I did it for like $1.60 credit. So I will profit if it goes down, but you know, ultimately, if Lululemon goes up, then I can still collect at least some credit for being wrong, which you can't always do with most different spreads. Like I said, this is a front ratio put spread, and you're going to be buying one at the money or just slightly out of the money put. I usually default to the one that is just out of the money. Depending on how bearish I am. If this is really one that trades completely sideways, then I might be buying one that's in the money, just slightly therein. And then we're going to sell two further out of the money puts to finance that and to collect a credit. You know, if you're just doing it a 1-to-1, you're going to be paying a debit for this because the one you're buying is worth a lot more than the one you're selling. But we're going to try and sell an extra one, which will somewhat simulate being naked short a put, but when you're doing it this way, you're increasing your risk a little bit, but you're lowering your break even because we're using puts. So we're going to be having a break even that's further down the chain, if you will, and then it will slightly increase your margin than doing a just naked put, but that will ultimately increase our probability of profit and our return on the capital. So, and Rich is asking, will this be work with the calls? And yes, next week I'm actually going to be going through this webinar from the call side. It just is way too difficult to do both of them within 1 hour session. And I think it adds a little bit more confusion when you start going back and forth with those. So stay tuned for next week. Yes, next week, what is that, the 20th or something? All right, so I always go through this. This is one of my checklists to come up with different strategies and to make sure I'm still on task going forward. So the first thing we need to do is pick the right strikes. And we want to make sure that by picking these strikes, when we're going through this, that we at least do this for a scratch, which means you're not paying a credit or a debit, it's just basically zero, to preferring to receive a credit. So that if we are wrong, we get to collect that credit and you know, we didn't lose any money there. We also want to pick the right duration. The right duration for this particular strategy is going to be within this 35-day to about 10-day window. The reason why we don't want to go further here is because there's some gamma risk is really what it comes down to. The gamma on the option Greeks really inflates within that last 7 days. So that is one that that's where we kind of want to stay away from, especially if we are right, and we don't want to take that all the way to expiration, because if it moves just a little bit, we're going to see big fluctuations. So we're going to try and get out of this relatively early. So we're not really looking to collect the full credit on this. We're going to be looking to manage this rather quickly so that we don't have to take it all the way into the end of the day. Are the strikes in the same month? Yes, good question. The strikes will be in the same month. Okay. It looks like a ratio put backs. The back spread is generally considered where you're doing it for a debit and you're buying two puts that are close to at the money, and you're selling one away. A front ratio put spread is going to be one where we are selling two further out of the money to finance that long put, Colleen. Okay, so we're going to try and pick this area here, because anytime you're doing it for a credit, a strategy for a credit, you want theta decay, and that's what this is, and that's duration. Theta is time. So whenever you're looking at the options chain and you start seeing theta, that is what this graph really depicts, and depicts it very well in my eyes. The further out in duration, as you can see, the further out days to expiration, the slope of this is relatively slow moving. But once you get inside this 35 days, you can see where it really starts picking up. And we get about a 50% drop in our premiums within these days. Now, it can be a little less slope depending on volatility, and we're going to be doing this strategy in an environment where we have a lot of vega, and vega is the volatility, and volatility has a tendency to support this and flatten this out. It feels like it's flattening it out. The theta doesn't really come out of it here very quickly. So then if we can get into these days and we get that volatility to come out, this steepens even more through here. So that's what we're looking to have happen, to have a high volatility product. We're going to be entering this with high volatility, and then we want the vol to come out ultimately during or shortly after putting this on. We want the volatility to revert back to the mean, if you will. And we want to pick the right underlying. So a lot of people, a lot of people trade a lot of different products, right? But we really want to implement this strategy with something that has a lot of open interest, a lot of volume, a lot of participation. It doesn't have to be as much participation as Apple. That's a $100 product, or at least used to be. But there's a very tight bid ask there for being a $100 product, if you will, where you're getting 2 cents wide. One thing I always look at is the volume and open interest, obviously, but if it's under a $100 product, I really want that bid ask to be within 10 cents. And I try to stick to that. 11 cents, I might bend it a little bit here and there, depending on the product or depending on my assumption. But think of it that way. If it's a $100 product or less, you really want that bid ask to at least be right around 10 cents or so wide. TJ is asking, is this my favorite strategy? I wouldn't say it's my favorite, but it is definitely up there. I like to do strangles for the most part, which is basically selling a call and a put. But this, when I have a market directional assumption and there's a lot of high volatility, then yes, definitely this is one of them that I like to do, because if I'm selling a put and I'm going to do it naked, a lot of times I just look at it like, well, if I'm selling that naked put, I could just sell the naked call and collect some credit there too, just in case I'm wrong. This is going to be one where, like, if I am pretty bearish on the underlying, I'll wrap it around something like this. So yes, if I am very directional on something, this is one of the ones that I really like to use. One thing I didn't mention with this is, if you guys are building this portfolio, don't ever be beholden to one particular strategy. Try and mix in several different strategies, and don't allocate more than, say, 5% of your overall portfolio to any one particular underlying, for that matter. And make sure that you have a lot of different strategies going on there. You just don't want to be the one-trick pony, because you're kind of really beholden to that that strategy, if you will. All right, so, and know our exit strategy before entering this trade. Like I said, we're not going to take this thing into the bitter end. If we are wrong, this is one of the times where I'm going to probably let this decay and you know, especially if we were really wrong and we collected a credit, I'm going to let this really end up out of the money and probably collect more than 50% of that credit that I got. But what I'm going to be looking for is probably collecting about 50% of my overall max profit, which will allow us to get out of this strategy rather quickly. We don't want to try and milk it to the last day or to the end and try and pin that strike, because the probabilities of you guys picking the right strike and pinning it there are not very good. So that's another reason why I manage everything early, because if I'm right away, then I'm getting out, because the market's going to continue to move back and forth. So I like to manage my stuff rather quickly. And if you start getting a gut feeling like, hey, I probably should get out of this, that is the time to get out of it, even if it's not 50% of the max profit or whatever. If you all of a sudden start getting this gut feeling, maybe I should get out of this, and then you start thinking of reasons why you should stay in the trade, and you probably should just get out of it, reallocate it somewhere else, and move on. So always keep that in mind. Go with your gut. Don't try and reason yourself out of it just because it hasn't met a particular goal that you were looking for, all right, or cover part of it, because that probably means you're trading a little too big. And one thing I did mention, or forgot to mention, with that 2x1, since we're doing this 2x1, that just means for every one contract we're buying, we're selling 2. So if you are used to using, say, doing 10 lots, then I would do it like 5x10 kind of thing, something along those lines, or 2x4 kind of thing. All right. Credit spread is the best. I agree with you, Francis. All right, so our max profit on this is going to be our long strike minus the short strike plus the net credit received. So we're going to try and do this for a credit. And what this is saying is if XYZ, when we implemented this strategy, was trading somewhere around 50, let's say it was trading $51, then we are going to buy like the 50 put and then sell 2 of the 45 puts. Now let's just say we collected 50 cents for that overall strategy. We got a credit of 50 cents. Our max profit is going to be the width of those, which is $5 plus that 50 cents. So keep in mind that you're going to be able to collect more than the width of that strike. And I would probably close this strategy at $2.50 if I was able to get to that. And if it rallied up and I was wrong, then I would probably just let my 50 cents decay and go with that. Does that make sense? So if I'm wrong, I'm usually letting this run out a little longer. If I'm right and I can get close to 50% of my max profit, maybe even sometimes 30% of my max profit, that's where I'm going to be looking to exit this strategy. And more likely exit this strategy if I'm right really fast. I'm going to be looking to cover it even with a less percent, because if I'm right really fast, it could just continue to keep going, is usually the way I look at it. But this is something that I want to see kind of pop back and forth, rally, come back off, and we want kind of a sideways market with this one. And the reason why is because if we start getting that sideways trend, we're going to see volatility come out rather quickly. One thing with the puts is puts are really something that if the market starts going down, that inflates volatility rather quickly, and we really don't want to see that. We would really like to see this kind of start to flatline for us. Does that make sense, you guys? What I'm talking about there? Volatility usually in stocks, things related to that, they go down, volatility goes up. Commodities, gold, soybeans, stuff like that, when they go up, that's when volatility goes up. Commodities are a little different. They go up, volatility has a tendency to go up. With stocks and like equities, when they go down, that's when the fear comes in. We will be. I'm trying to get through the boring stuff, Dan. We'll get to the platform rather quickly here. So I'll try and pick it up a little bit. So your max loss is going to be basically your short strike, that 45 strike, and that max profit we talked about, which is $5.50, and subtract that. So $5.50 from that 45 strike, we're talking $39.50. So when the underlying trades down past $39.50 to zero, that would be our max loss, from $39.50 to zero. Now, having said that, I kind of gave away what the break even is. It's the short strike minus the max profit. So the break even would be that $39.50. Anything below that, you're starting to lose money to zero. Okay. All right. And here we go. We're going to go to the platform because I think that is all of our slides there. So let me pull up the platform. Oh, I got it on the wrong side. All right, so this is the Thinkorswim platform. So, and this is usually where I kind of go in and talk about, you guys, if you have some stocks you want me to look at, this is the time to do it. Now, we're looking at high implied volatility, and I've done some webinars on how to pull this up, and this is one of the first things I look at. But basically, to find this on TOS, I don't know how you find it on everybody else's platform, is you just go over here and you type in IV percent and then double click on it and it'll come over here. Just type IV percent and it'll populate over here, pull it over here, and that adds it to the column. As you can see, I always filter everything from high implied volatility percent to low implied volatility percent because my default is usually to go with high implied volatility. This blue line is what implied volatility is. Historical volatility is in the purple. I don't really use historical volatility, to be quite honest. But historical volatility basically tells you that that where implied volatility was in the past, implied volatility percent tells, or implied volatility tells you where implied volatility is expected to be in the future. So, and that percent is determined by a numerator and a denominator, and you take where implied volatility is now, subtract it from the low. That sum is then divided by the denominator, which is the high minus the low, and that comes up with the percentage of what implied volatility percent is. So that's something to know as well. All right, so we got, try and start from the top here, and I got Visa first to come up. Visa has pretty low implied volatility percent, and you know, they just had their earnings. So this would be something I would probably pass on, most likely, because we don't want implied volatility to expand on us because we're collecting a credit, and we could be directionally right in this strategy, and if implied volatility starts working against us, it's not going to allow our theta to happen, or our theta decay to happen, and it's going to pump up those premiums, which is going to hurt us. So we could be directionally right and still have that go in our face. The next one is SPX, and you know, one thing about SPX or something like this is a good example of knowing that way to figure out implied volatility percent, because remember way back in August, this is going to throw that off because we had that huge volatility on that little mini crash that we had there. So you can see this massive spike. So the implied volatility percent is actually going to be adding that in as the high minus the low, which is going to skew that a little bit. So the thing to do to see if it'll still fit the parameters of being with ETFs, one thing I did mention, you know, high implied volatility, what is that? Where are my rules for that? For this particular strategy, like anything when I'm collecting a credit, for an individual stock, I'm looking at 50 IV percent over here, as you can see, these are like 70s. I don't really want to do this around earnings because I'm going to be so close to at the money. I don't like to do this strategy around earnings. So I'm going to be looking for something that doesn't have earnings, something that is above 50, which we are pretty limited. You know, I might go a couple of percentage points below it, especially if I'm looking at IV coming out, and I am looking for IV to come out of a lot of things right now. Just I think we're going to continue to move sideways for a little while. I mean, we're having some big moves back and forth, but ultimately we're back to the same place. So to know this formula, you know, you take where it's trading right now, which is right around 60 or 16, I'm sorry. Let's just say 20 to make math easy. 20 minus the low, which is around 5. So on our numerator, we have 15. And if we want to take out that massive spike, this, you know, anomaly, if you will, you could go let's just say the high was somewhere around 60%, because we're going to take out that high a little bit, minus 5. So we have 15 divided by 55, and I don't have my calculator up. Somebody probably can do that for me, but that's going to be in the lower, you know, probably 27% or something like that. Having said that, with ETFs and different indices, because there's so many underlyings embedded within that, you're really going to see a lot less IV percent in there, because they're going to kind of Nick's throwing out there 27.3. But I came up with 27 off the top of my head. That's pretty. I'll be happy with that. So the 30 would be something for the ETF. So that, you know, this SPX, I might go ahead and do that if, you know, I was pretty inclined to think that we are going to either trade sideways. And this is what I'm talking about. We kind of rallied up, came back off, rallied up, came back off. Monday we're probably going to start moving back higher, you know, if that's my assumption, or just kind of keep popping along here and see volatility continue to come out of there. So this one would be something that we could definitely look at. And, you know, you can see, you know, anytime there's this many different options in the chain, there's a high likelihood there's a lot of open interest and volume. And as you can see, even these really far out of the money ones for this high flyer of a underlying, it's pretty darn tight. So let's just scroll down. And this is the big dog. So, you know, this is something that you have to take that into account, whether or not this is going to be less than, you know, 5% of your overall portfolio. You don't want this to be this one particular strategy and this one particular underlying to be over, you know, especially 10% of your portfolio. This, I would probably, you know, if I wanted to hedge a portfolio of overall stocks, like if I was just had all stocks in there, then, and this was going to be an idea to hedge that rest of that portfolio, then yes, you could go a little bit more than 5% of that portfolio and maybe go into, you know, 10, 15%, depending on how bearish you are. But yeah, the dogs aren't barking, and the wolf daddy, the wolf pups aren't barking. No, they aren't, not yet. Nobody's knocked on the door. But so going at this strategy, we can tell we have a lot of volume and open interest. You know, it's a $2,000 product. So to have inside of, you know, $1 is really nice. It's just slightly outside of $1, but in some cases, you know, you'll get inside of $1. And because there's so much volume, you know, 4,000 at this strike today, it's 6,000 at that strike, you can, I would start not necessarily mid-market, which would be right around, you know, $35 for this. I would probably start out at $34.60 as my bid, or, you know, just a few pennies above the natural bid, or, you know, if I was going to be collecting a credit, you know, trying to sell this, you know, maybe 10 cents off of what the natural getting both edges was, and then slowly move that down to mid-market. So One thing with options trading, you guys should have a lot of cancel replaces, which means you put an offer in and nobody hits you, let it sit there. If you put an offer in and all of a sudden it goes off, ding, you're filled, well, you may have given up a little bit of edge there. So keep that in mind. Don't always just go to the mid-market and put it out there. Start it a little bit further, especially in these ones that there's a lot of volume on any given day, because there's somebody out there willing to give up a bit of edge. Okay? And another thing is don't try and leg into this as like a, you know, a debit spread and then go and collect the credit, because the counterparty risk for the person that's on the other side, you know, or the risk associated to him having to leg something is going to cost you in having to give up edge. He will give up edge if it comes out as, you know, as one whole strategy. So for instance, this one, you know, I like to pick the one that's just slightly out of the money, and you know, the 46 is just slightly out of the money. So what we would do is we would go in here on the put side and we're going to buy it. So we're going to look to go to the bid side, and then we're going to want to do this 1 by 2. So we're buying one and we're doing $35. So this one, $35, to get to $35, I'm going to have to do something that's around probably $18. So we're going to look to which one is right around $18, and that would be probably this, the 1990s. So then we go in and we're going to hold down control, hit sell. You can also, you can see it says back ratio on here. You know, they do that as a back ratio, and I don't know why. It's not really proper. It's really a front ratio. But I don't even think they say it's a front ratio. But that is proper terminology for this strategy, is a front ratio, not necessarily, it's not a back ratio really. Because like I said, a back ratio would be buying these two and then selling only one of these. You can't lose more than the credit you collect. You can't lose more than the credit you collect only if we're wrong. So like in this regard, if we're wrong and the SPX or the S&Ps go straight up from here, then we get to collect this credit. So yes, that is correct. But on the downside, where our break even would come in, is the difference between these is 55 points, right? So we would collect all 55 points if it came down here and pinned on this, you know, at or near expiration. That would be our max profit plus this $2.50. If it, you know, on the last day of trading, it was trading 1990 or 1990 and a half, let's say, or 1991 or something like that. We're basically going to collect the whole width of this because we bought these puts. So we collected all the way down to here. These would expire worthless. So we're collecting that width, which is 55 plus this $2.40. That would be our max profit. I would be looking to collect half of that on this strategy. So if we started trading down here, then I'd probably be looking to cover this after about, you know, a week or two. Yeah, TOS only shows it as a back ratio, right? Do I have to customize it for a front ratio? No, even though I customize this for a front ratio, it always says back ratio. I've never seen it come up as a front ratio. But, you know, and then again, I always build out all my strategies too. I don't ever go up here, and I always leave it on single. I don't go in and go through these and do it, because I don't like the strikes that they pick for one, and I like the strikes that I do. See, here it is, back ratio, and there's no default to go front ratio. Why did I pick the 1990s as my short strike? Only because if I did this to the 1985s. I'm guessing, well, you could. I was just looking at it as an eyeball idea and thinking that I wouldn't be able to collect any credit. So you could totally go and add that $5 to the downside and only collect, you're still collecting 10 cents, which is good. So great question, John. I just did it, in my head, thinking that doubling the 1770s wasn't going to give me enough to cover my debit I paid for here. Great question. So you could definitely do that with those because you're still collecting a credit. Ultimately, I want to collect a credit or do it for zero. If I had to start, if I entered this mid-market on a particular thing, you can see the natural is negative $1.90. I would never go that far. The lowest I would go on this would be zero. Okay. Does that make sense? Right, and not all legs will necessarily get executed on that. Well, they will if you do it as the blast all. Where is it? The blast all. I don't know. I'm cramping right now. Best. And you can go to best and blast all. Is it blast all? I've never really had a problem, especially on the on the ones where there's a lot of open interest, not getting filled on one of them. Yes, so if there is a black swan event, yes, you could definitely, you have unlimited risk to the downside with this strategy because you have something that is undefined. Okay, one thing, and this is a big underlying, and you are going to have your margins going to be probably set. Usually they set it to 1 standard deviation, so that's going to be basically where your margin is and how much you're going to have to put up for it. All right, let's look at a couple other examples. With your risk on this is, so you got $55, so your break even on this to the downside, subtract $55 as a ballpark. Oh, sorry, we did the $85, so it's $60 to the downside. So your risk is to the 1925, which is just slightly outside of 1 standard deviation. You could even say that's a 1 standard deviation move, which is something that rarely happens, right? It only happens 15% of the time. So, and your probability of being tested on that is about 30%, because probability of being tested on any particular strike is double the delta, you guys. So that's something to remember. Probability of being in the money at expiration is the delta, as a ballpark, and your probability of being tested is double that. So always know that, you know your probabilities of what's happening, because that is ultimately what is going to, either make you understand your risk and want to get out, or say, hey, my probabilities of being in the money are only 30%. My probabilities, going into this, I know are 30% or are 60% that the market will come down here within the next 34 days and test that, which is another reason why we want to do this in high implied volatility markets, because we can get further away and still collect a nice premium. And usually when fear hits the market, it's usually at the worst time. When volatility hits the highest point is usually when there's blood in the water, and that's when you want to be adding risk from the selling of options, because you can see that it reverts to the mean. This is when people are panicking, and when people are panicking is the time that you make the most money. You can see when people weren't panicking, there was no money to be made. It was just trading sideways. But when people panic, that's when it's time to come in. because that volatility crush will likely happen rather quickly. And volatility comes out of the market a lot faster usually than it takes to get into the market, because it's reverting back to the mean. People have that panic, volatility spikes, you come in, save the day, volatility comes out, you collect the premium. That's the idea, is volatility reverts back to the mean, or settles back down. Would it be smart to do a put ratio spread and a ratio call spread at the same time, or is it too much? Nick, I would probably end up defaulting to something like the strangle in that regard, just because once you start doing so many different legs, you're giving up a little bit of edge here, a little bit of edge there, because it's three legs, on one side, 3 legs on the other side. You're talking about a lot of commissions. I would probably go to the either the iron condor or the strangle if I were thinking that. And that would be because I don't have a necessarily have an assumption on the market, which is fine. I mean, I a lot of times don't have an assumption on a particular underlying or whatever. Sometimes I'm looking for things to add short delta, long deltas, keep my deltas in my portfolio the same. So then I'll do like the strangle or something like that if I'm happy with my deltas, but I want to add another strategy. And remember, when you're short deltas, so this is going to be, when we build this out, we are going to be long deltas. So, I said it's a bearish to market neutral. And the reason why it's more market neutral and even possibly bullish when we're doing this with the strategy with the 90s especially, let's just do, is it going to mess this up for me because I did it that way? So let's go, we're going to buy this. Let's just move this down to 5 just to make it so it populates rather quickly, and hold down control. So that's 2 by 1, right? 5 by 10 is 2 by 1. Still come up with basically the same credit. And so because we did 2 of these for every 1 of these, we doubled our delta. So we are short this delta, so a negative plus a negative gives us positive, right? So we are actually positive 60 delta by doing 2 of these. We're positive 60 delta here, and by buying this one, we're buying a negative plus a negative is a negative, so we're negative 52 delta. So we are slightly bullish on our deltas, which means we have a slightly bullish assumption on that. The closer we get to having a 0, and that's why we're getting a credit there. When we change this to the 85s, it's a 10-cent credit, and if you double this delta, that gives you 56. So we're very close to being delta neutral there. So you're only 4 deltas long, whereas this one we're 8 deltas long. Does that make sense when I'm talking about the deltas there? That could be confusing. I've done a video on just deltas and stuff like that, and how there's like 5 different ways delta can be looked at by an options trader. Probability of being tested. Yeah, this is a really important one. Thank you, Pete, for bringing that up. For people that aren't really this was something that was a floor trader thing, is your delta is the probability, and it's a ballpark, probability of being in the money at expiration by 1 penny. Okay, that's your delta. That's basically what your delta is telling you. It's a probability that strike will be in the money at expiration in 34 days by 1 penny. The probability of being tested, of the market coming down and touching it and maybe coming away from it, just tested, is double that. So there's a 60% chance that the market will come down and boom, come back off. So that's the probability of being tested. Probability of being tested is double the delta. Double the delta is the probability of being tested. Same thing. Yeah, and these are direction, you know, the reason why, okay, so Byron's asking, you stated earlier these trades were directionally biased assumptions. Yes, we are, because we're going to make the most money if it comes down, right? And the further this comes down, it's only on the initiation of this. As you can see, the further this market comes down, the deltas get bigger, right? For the ones that go into the money more. So it is, the further this goes down, is going to become more delta negative. And how do I know to sell those 1990s? It's the one that gives me the credit. Anything that gives me a credit. The 1985s give me a credit also. So, you know, it's kind of a pick 'em. You know, if, you know, you want to collect a nice credit on the way up, you could do it right there. The only reason why I picked the 1990s right off the bat was because I did the math in my head by saying, okay, $35 credit, how do I get a $35 credit? Well, I need at least $18. $18 is somewhere right in here, right? You know, I didn't think that if you doubled this, because 18 plus 18 is 36, that would give me a 50-cent credit in my head. So I just did it in my head really quick, and that's why I originally picked that strike. You could do the 1885s, but you're not getting much of a credit, and it's mid-market. You're going to likely have to walk that down a couple of pennies or so. And if you started with these 1885s going into negative territory, I would go back up and default to these 1990s. Does that make sense? Dan asked, great question. Is it better to get zero credit or get a couple of dollars? I always like to get a little credit rather than zero. But that's me. Just because I like to get a nice credit if I'm wrong. Okay. Okay. So I'm going to pull up a couple examples that I thought would be appropriate for, you know, the you know, guy that maybe has a smaller portfolio. This one, you're going to need a pretty big portfolio, and I would probably do it if I was mostly just long stocks, or a very large portfolio that Mosaic is one that has a 50 IV. It also doesn't have any earnings in it. You know, they came in line with expectations, right? We still have a high IV percent. So the assumption here is that there's no more events happening for Mosaic, you know, a binary event like an earnings, which usually increases volatility. And if it continues, because it came right in line with expectations, continue to move back and forth, maybe up or whatever. But the idea is it's not really, the news hasn't been super bearish for them. Yeah, Nick, I'll check on that one here in just a second. Let me try and run through this one real quick. So, you know, but it's been in a downtrend even before the earnings. After earnings came in line, they still got hit. Maybe a bit of a rebound. See if it comes back down. I would say I would lean towards this is going to come back down. So we're right there at 24. You know, like I said, so if you pick the ones that are in the money, you're going to have to sell, you know, these 24s to get that credit to pay for it. So I usually default to just outside of it. So I would go to buy these one time, and I'm going to do it just for 5. So it actually, you know what, if I do it first, then it'll do it. So I've got to collect at least $1 by doing a multiple of 2. So I can't really do the 21s because that's only going to give me, you know, about 50, maybe a 58-cent credit, and I'm going to be paying 50 cents for it. So I would look to sell these, and oh shoot, I didn't do that right. Sorry guys. Let me just do this again. Buy that. We're going to do it one time, and then control, sell that take that down to 2. Okay, so we're getting a 6-cent credit. So this one, you know, we've got 48 deltas to the upside, so we're, you know, long deltas. So, you know, in a sense, it is slightly, you know, it's neutral to bearish because we're bearish. We want to make that full, you know, what is that, $1.50 plus the 6 cents. So we want to make that $1.50 here if it continues to go down and hits this. And then that $1.50 tells us our break even is at the 21 strikes. So that 21-ish would be right around our break even. Remember, it's the difference between the 2 strikes, which is $1.50 plus the 6 cents, is our break even to the downside. So you subtract $1.56 from that, and it's really right around 21, right? Byron's asking, how do I cover that short put? Great question. So, you know, Mosaic's kind of acting funky here because the offers, but I usually go down to the first one that I can pay a nickel for, and it's probably these 14s. For some reason they're showing it as 25, but I would go to pay only a nickel for these 14s, and that creates your defined risk to the downside. And it doesn't really decrease your risk very much because you can see the delta is 2 there, which means there's only a 2% probability that'll be in the money. So you still have all this risk from 21 to 15. But that creates that loophole where you have defined that risk. That answer your question, Byron? Yes, if you're selling the puts, you are bullish in that sense, and that's where the delta, long delta comes in. So if you're naked selling a put, you are slightly bullish, but to collect our, you know, to do this strategy and only collect 6 cents for a bullish, it really makes you slightly bearish, right? So you do want to collect some premium. So it is a bit counterintuitive because you are selling a put and are still bearish. We are just not really bearish this. We really want this to be market neutral, come back and forth. We do want it to come down and test our 2250s. We want that to come down there and touch that, but we don't want it to continue down. So the way to make money on this is if it goes down, because to do all of this for a 6-cent credit isn't really what we're looking for. But great comment, Trevor, is yes, when you're naked selling a put, you are bullish because you don't want that. But we also are doing this to collect the credit and make money on the downside, because that's really where we're going to make our money. Okay, so what was it? Herbalife, I think, was one of them. Apple, somebody asked about Apple. Apple would be a good one, except for Apple has just, I know Apple has really low implied volatility. Wait, what was I'm sorry, HLF. So Herbalife, you know, being a $61 stock, it's outside of that 10 cents, and that's why I don't usually trade this. It's pretty wide, but if I was bearish on this particular stock, there isn't any earnings because they just had it. Looks like it wants to cover that gap, so yeah, this would be something that I might look into doing then. So in that regard, $61, so this 60 strike is just the one that's out of the money, but you know, pretty darn close to at the money. It's closer to at the money than those are, which are in the money. So I'd say that's the at the money. And then so $3.30, so we need to at least collect $3. So you're probably going to go to this 55 strike, and before I do that, I need to change this so it doesn't make it just a regular spread. And the $55, control, hold that down, change this to 2, and we get a 28-cent credit. So our max profit on this would be $5 plus the 28 cents if we came back down here. $5 plus the 28 cents, our break even is going to be $49.80. So on covering the naked put, you have to do 4 legs. Yeah, you're Byron, you are creating a broken wing butterfly is what it's really called. You're creating a broken wing put butterfly, because a broken wing put butterfly, a butterfly would be 60 to 55 to 50. That would be your regular butterfly. But because we're going way out here and, they're not giving us the options that far, you'd buy this furthest out of the one. So you're not really decreasing your risk at all. Maybe this 26 here. You're not really decreasing your risk at all, because the likelihood of it going that far down isn't very good. But it will act the same. Does that make sense, Byron? It'll act the same by buying that really far out as this would. And I don't think it probably wouldn't decrease your margin requirement for this strategy, because they usually make you margin out to 1 standard deviation move, which is, going to be right in here somewhere. Yeah, so John said you're confused. Yes, absolutely. You're converting it to a put butterfly if you had to do that. Does that make sense, everybody? How to build that out? I mean, some people have to do it that way. So, I mean, it is what it is. And the same thing goes with calls, sometimes you have to do that, especially if you're trading in an IRA or something. So it's yes, it is a far broken wing butterfly. But, the system doesn't take that into account. It just takes into account that, hey, you know what? He's defined his risk. The benefit of, well, some companies or some accounts, they aren't allowed to do non-defined risk strategies. So it's a bit of a loophole that you are defining the risk, but you're defining it so far out that it's not going to feel defined. Does that make sense? Which is always strange to me that you can go out and buy a stock. When you buy a stock, that's it's really undefined. You bought a stock and it could go to 0. But, this is leveraged, so that's the way they're looking at it, as from, a risk perspective, that you've only margined up so much of that strategy that, you got to define your risk somehow. Thanks, Rich. Appreciate it. Thank you for the kind words. All right, that's all I got for you guys today. Like I mentioned earlier, next week we're going to be doing this pretty much the same thing, but we're going to be doing it from the call side. This is a premium membership trial offer. Basically you get the daily market commentaries, which I go in through, and I didn't have a chance to go over my Lulu trade, but if you watch the daily market commentary, I talked about, I did the June 60, 62 and a half put 2x1, which I bought one 62 and a half put, sold 2 of the 60 puts, and I collected $1.61 on that Lulu. So, I could care less if Lulu goes up. I'll end up getting to collect that $1.61. So, you get that whole thing, what I'm talking about with these strategies. I talk about my losers too. I talked about my Disney earning trade that was a loser, and I talk about when they become losers and how I defend those, and what steps I go through and when I'm going to look to defend those. So those are very informative. So please watch those too. And then you also get the online options trading lesson video archives. I've just done the ones on like Delta, Vega, Theta, and Gamma. So you can check those out if you're not really familiar with it. And I might even mention a couple of things that you didn't know about it, like that probability of being tested with the delta. You know, most people talk about the four things: a hedge ratio, you know, a percent of your portfolio ratio, probability of being in the money, and things of that nature, and how it affects the premium. But I go in and talk about that probability of being tested. So you might learn something even if you know a lot about options. So that's on those, you know, trading lesson video archives. Are usually about 10 minutes long. And then these live workshops where we go back and forth. And I love to go back and forth because, you know, we get to go through the steps of what works and what doesn't work, you know, like with Apple. You know, I didn't get a chance to go to Apple, but I know it has low implied volatility percent. And that would be something where if you're bearish in Apple, then you might be looking to do buying the put spread, which I did the webinar on last week. So that would be a good one to look at for that strategy, or for that particular underlying. All right, so you can go to protraderstrategies.com and check that out. There's also a link right there in the chat box. It's not in the questions box that we've been talking back and forth on. It's in that questions box, or in the chat box. There should be a link there. And if you guys have any strategies that I haven't gone over, or you would like me to revisit it, you know, make it more pertinent to now, please write to us at protraderstrategies.com, which is this right here, you know, trading@protraderstrategies.com. Give us some ideas. I'd love to go over it. You know, maybe I've missed one or two of these strategies. You know, I haven't gone over all of them just because some of them I don't really use very often, and haven't ever really made a lot of money with them. So sometimes, you know, if I'm doing it from the short side, it's because that's where I've made the money, and I don't really agree with paying a lot for this muffler or this options strategy. So, you know, I usually like to collect the credit. But in later webinars, I'll be drilling down on different options and the components of those options, how to trade options, trades I find, and when and where I find them appropriate. For instance, I'm going to be looking at doing potash and Mosaic on Monday because those guys have the high implied volatility there. I may even look at I think it was Nick's Herbalife. I haven't traded Herbalife, so maybe that would be something I'll throw in there too. So stay tuned for that on those daily market commentaries. All right, appreciate it. Thank you guys all for the kind words. I appreciate you guys sticking around on a Friday late in the day. And if you can't take that, take it easy. Thanks, Pete. Thanks, Trevor. Thank you, guys.